Tools for techs, understanding and trading 4 types of gaps. All right, it's earnings season, and you could almost call that gap season because the charts are often loaded with gaps, and this is a really good time to look at what those gaps mean and how you trade them. What is a gap? It's basically an empty space in the chart that's left between 2 bars. Now, we're mostly looking at gaps on daily bars when we do our analysis because they don't show up much on interdays because, well, you move from one gap to the other without any news except for the case of an overnight situation. And in the case of weekly bars, well, the only gaps come usually on Mondays because if you have some big move on a Monday morning, it can leave a gap for the week. So it's mostly gaps show up on daily charts, and that's what this analysis is going to look at. There are several types of gaps. And they're all going to show up during earnings season, and they're almost all event driven. Something happens, some news comes out, some corporate news, or earnings come out, or some analyst comes out and says something about a particular stock. That's what causes the gaps. Common gap is basically in the middle of a pattern. It's a continuation. I'm going to show you that, and I'm going to show you examples of all of these. Exhaustion gaps usually come late in moves. They're high volume, and most of these gaps that you're going to see are going to be higher volume. But there's also some sort of a reversal pattern that happens either on the day of the gap or within a few days. And sometimes some pretty interesting chart patterns shape up right around those same time periods. Breakaway gaps, those are out of particular patterns. So there'll be a consolidation pattern, there'll be a downtrend, and all of a sudden it'll break away from the downtrend with an upside move, or there'll be an uptrend and you'll usually have a trend line and it'll break away from that with a downside move. So breakaways usually have very high volume and are very important. All the gaps are really important. And you're going to see now, we're going to show you gap reverse and what I call a hidden gap. And those are the ones that really signal some important reversals. So those are really 4 different type of gaps that we're going to look at. So being that it's earnings season, I hope that a lot of these examples that we're going to look at give you some sense of how to trade these gaps as they form in the charts. And also, I'm so attuned to momentum. Also, understanding that usually when these gaps occur, they're starting a period where momentum is likely to continue for a while, maybe quite a while, and maybe in the case of something like a breakaway or a gap reverse, you're going to end up getting locations on charts that may never be seen again for a long period of time. So these are really significant and I think really important to your trading. So we're really on this in this session. We're going to focus on all of them, and I think you're going to see that the most common are the breakaway gaps, and the least common are the exhaustion or reversals, gap reverse as we call it, or hidden gaps. And I'm going to show you all of those. So let's just go to the charts now. What I have here is just a daily candlestick chart. I didn't want to bring anything but that and volume because I don't want to convolute the understanding of this. Now, if you are looking at more complex charts and you have momentum that you're looking at by any of the momentum studies that you see me focus on, I think you're going to see when reversals come on gap reverse and maybe even breakaways, that you're going to get following those occurrences, you're going to see momentum change. And those are going to be the beginning of momentum trends. So that's a really important aspect to consider when you're looking at more complex charts with a little more information on them. But this is just going to be the simple chart that you can see right in here. So here's an example of a common gap. You can see that in Spirit Airlines. There's really nothing significant about the location of this. It happened in the middle of a trend. In other words, it was in a downtrend already. Some news came out, I'm not sure what that is, but you had this gap on the downside. So what's important to see in here is that, well, it was in the middle of a trend, right? And after that, it continued on the downside. So momentum was already there on the downside. And it's a continuation. It's a common gap, or often called a continuation gap. You can see another example of that right over here in Boeing, BA, where you see this gap right in here. So I didn't mark this off for you to see, but you can see it was already in an uptrend right over here. So something came out. I have a feeling this was some analyst information right over here. And you got a gap right in here. So it was a continuation. It just continued on the upside in there. And you can see it's a double gap. In candlestick terms, these are called windows. And this is a perfect example of how strong one of these continuation gaps is, and how strong that information is. You saw it in Spirit Airlines, how it continued on the downside. Here you could see how it continued on the upside. It made a triangular force up right in here. So this was your consolidation after that, and then it continued on the upside. So this was all big, powerful upside move, and these are the continuation gaps that you can see right in there. And you'll note the high volume on the gap, and that's pretty consistently what you're going to see happen. So those are, just a couple of examples I wanted to give you of common gaps. The common gaps are probably going to give you less trading opportunity because they're in the middle of patterns. You're not going to be really sure about them when they happen. Usually they're making, higher highs or higher lows, and you're going to be suspicious about exhaustion. In other words, they're really continuing moving, and you're not going to jump right on them because you want to make sure that, well, it doesn't turn out to be an exhaustion gap. I'll show you those exhaustion gaps in a moment, and you'll get an idea of that. So we'll call common gaps or continuation gaps the ones that probably are going to offer you the least amount of opportunity. So now we're going to move into more opportunity, and I think some much more interesting patterns that we're going to look at. So we're going to look at JetBlue in here because that has a lot of information on gaps and using patterns regarding gaps and getting a sense for what a breakaway gap is, what an exhaustion gap is. So, I'm using these terms and I want you to see them. So this is great. This is why I chose JetBlue as an example, because it has so much on here for you to see. The first of all, what I want you to see is there's an exhaustion gap in here. You see this? It was in a long downtrend over here. Now, what it gives you a lot of information about an exhaustion gap is that it's usually going to be an increasing volume, which you see happening right over here, and it's going to give you some kind of a reversal. So you see that was a upward turn. Right there, and it turned, and you could see that. Now, there's a tool that I don't have on here because I didn't want to confuse the chart, called accumulation distribution. I often have that on my charts, and this will, when you get a high volume day that actually closes up higher than it began, you're going to see an upward pop in that accumulation distribution. That is another hint of an exhaustion gap. So you can also see that 2 days later you got a clear reversal right over there, and then you got an island in here. That's the island right there that you can see. Let me get that a little clearer, and because that was a gap down and then a gap up. So all of that is an indication of this exhaustion on the downside gap that you see in there. So that's essentially establishing a low price. Now what you can see that it did is it went into a inverted head and shoulders. Here's your left shoulder, here's your head, here's your right shoulder. You can see that clearly, and here is your neckline. Now I want you to notice that what it did was break away from the inverted head and shoulders. That's your breakaway gap. That's only 3 days ago. And that is pointing to a fact that it's likely that upward momentum is going to continue. It's been established and it's going to continue. An island reversal after an exhaustion period, an inverted head and shoulders, and a breakaway upside gap. All of that is just beautiful. And here's your upside measurement of the inverted head and shoulders, around 21.5. So, that's a reasonable target area when you see that on this chart. So you have lots of information here in jet blue, and one that's giving you, some sense of upside. And of course, the airline group has been doing better. And that's a pretty good example of an exhaustion gap. Next one we're going to look at is Pepsi, PEP. Look at this unbelievable thing. Now we have two things going on in here. We have an exhaustion gap. In other words, you had a long downtrend. You had a downside gap and big volume right in here. And then you had a gap reverse after that. In other words, it gapped down again. You can see that right over here. Reversed all the way up there to actually finish up on the day, getting up into those bars. So that is a beautiful picture of it getting exhausted on the downside, then an unusual condition of a gap reverse afterwards, and note the upward momentum being established. So, of course, we have a bull market, and we're in a period where there's likely to be rotation, and you could see that this is a stock that they are basically rotating into. So, after the gap reverse, you would expect it would be able to continue upside momentum. Sometimes they come back into the bar and then move up again, but this is a clear example of the exhaustion gap in there and that rare condition of a gap reverse right there. Let's look at CREE, C-R-E-E, a pretty volatile stock. And here you could see the exhaustion gap on the downside, and that's pretty close to a gap reverse right there. Not quite qualifying it, but big downside gap, huge volume, and then this big white bar that occurs right there. And you can see what happened after that. Well, that was clearly the end of the downtrend and the beginning of the upward momentum. So you could see that right in there. I mean, it's really clear, and that's a very important bar when you see that. So, and again, this is an example of what I believe you'd see a giant up move in the accumulation distribution indicator. I want you to consider looking at that on your charts when you're looking for confirmation on these gap reverse patterns. So that's a beautiful exhaustion gap right over there, and you can see that it could not stay down from that level, and that of course was the beginning of the buyers. So that's a pretty clear look at gap reverse. Of course, like I say, this is earnings period, and you're going to see some of those exhaustion gaps or gap reverse in this period for sure. So now we're going to look at a bunch of breakaway gaps, because these are so common and so valuable. And lots of people, when they see a stock, moving a gap away, they want to fade that move. They think, well, okay, that's excessive, and try to look for a turn. And I'm going to prove to you, how much of a mistake that is when you look at a lot of these charts. So let's take a look at a couple of them that basically are right now signals that are valuable for this moment. You know that I have been very bullish on Walmart and making a case for more than a month, maybe two, that Walmart's online growth is likely to continue to be strong, and some 2.5 times the rate of Amazon's right now. So I had been quite positive on Walmart, and you can see in here that you have a breakaway gap. So what makes it a breakaway? What makes it a breakaway is that it was in a consolidation pattern. right? It had a nice upside move. You can see right in here. There were some gaps right in here. They're not on very high volume, though you can see right in here that gap that was on high volume and reversed. So that's interesting, though I don't think it qualifies as any of the gaps that we're talking about. But here is your breakaway out of that pattern right there. And you can see once it did that and broke away from this, we'll call it a kind of a flag consolidation, it was a screamer. And normally when you get something like that, you just buy it because it's clear breakaway, and you could see it has continued to move on the upside. So this is a very bullish pattern. I think Walmart's a very bullish stock. That's a look at one of them. So we have quite a number to look at. Now, the other side of this is that I have Domino's listed on my 29 riskiest stocks for the fourth quarter. Here's Domino's Pizza after they reported earnings in line. However, their international sales, their foreign stores, are just not doing as well, and the growth isn't as good, and they're counting on that a lot. And you can see in here, depends on how you want to draw this trend line. Any way you do it, there was an uptrend that it broke away from right now. So that is clearly in Domino's a breakaway gap on high volume. And to me, it is establishing a new downtrend right now. So that I would expect to see Domino's continue to move to the downside, probably get to 170. Maybe there's an uptick in here as some people try to buy the dip, but I think that will be a selling opportunity. So I just wanted to bring you two that I think are important for what we're seeing right now. Take a look at KB Home. There's your breakaway gap right over there. You were in that downward trend. And look at the huge volume right in here, and look what happened. Now, typically, on these type of breakaway gaps, you can buy the opening on them because they're likely to be attracting a ton of buyers at that point. And you can see what happened in KB Home. It just continued on the upside. So you can see fading a breakaway gap can be extremely costly. So Walmart continuing up, Domino's just starting to the downside, and now this one, it was 2 weeks ago when that one broke out. Take a look at Costco. Here's your breakaway gap way out over here. This is a long time ago, about 4 months ago. So not a lot of value right now, but you could see one right in here that maybe is more value. You can see that, a high volume breakaway gap right there on the downside. So here's your island. You can see the gap on the upside. No volume there. It wasn't exhaustion. And then the island is completed and the breakaway gap on the downside. You get that big decline. Got to wonder if that isn't a breakaway gap again on the downside in Costco. So we didn't love the pattern in there, and this is pretty much enhancing that issue. Take a look at IBM. And you can see in here the breakaway gap. So there was a declining period in there and like a flag consolidation. You could see that right in here. It was trading in this kind of channel right there. And then right over here is your breakaway gap. And then it fell for a month on the downside from that point, from 154 down to 139. So you can see fading those things is really a very big mistake. Just an aside, the pattern in IBM on the longer term charts we look at is pretty bullish. Now take a look at CSX, Chassis Systems, or CSX Corp. It used to be Chassis Systems. There's your breakaway gap. You could see the upward trend and the big high volume downside gap. Did it make any sense to buy that when that happened? Just like I said on the upside, it makes sense to buy the opening on the upside. It makes sense to sell the opening on the downside. And you can see this one broke down from that point, 53, down to this level at about 48. That's a big trade if you believe in that momentum. So that's a look at CSX. Now, I want you to note something in here. I didn't note this one over here as any kind of significant gap, though that is a bear kicker pattern. Note there's no significant volume in here, so it didn't really attract me at that point. So I want to say what looks like it's something significant and what doesn't look like it's significant. So in this case, CSX had that beautiful breakaway gap that worked. This last gap does not look like a whole lot to me there because it's not a lot of volume. Take a look at Cummins engine, CMI, Cummins. There's your same type pattern, right? You see the breakaway gap. It made sense to sell it on the opening. It continued down. Then you got a bear flag, right? And then it continued on the downside again. So, from this point over here down to this point over here is 10 points on the downside in the stock. Pretty significant there. Note the massive volume, very typical of a breakaway gap on the downside after the upward trend. So it's a breakaway from a trend. Take a look at Herbalife. I mean, this one is just incredible. Downtrend, breakaway gap, consolidation, breakaway gap. If you bought that breakaway gap, you did wonders because look at that right over there. Incredible. It wasn't a big gap. It was a monstrous volume right there. And a good look at how that bullish breakaway gap was successful. Take a look at BX. That's the next one we're going to look at, which is Blackstone Group. Here's your breakaway gap right over here. You could see that's absolutely great looking right there. And ignore that little alert that I have in there that it comes off of a weekly chart that I have some information on. But very clear the breakaway gap that you could see there. And if you bought the opening, you were never wrong. So a nice move to the upside right in here, and that clearly worked. These breakaway gaps are, just a very high probability, high quality entry. Here's just a gorgeous one in here. So again, you had a downward trend, and the only thing we don't have is a huge volume, though we have increasing volume. That's because this volume was so high it kind of skews the chart. You had increasing volume, but here you had a gap on the downside, no real volume there that meant anything. So I don't see that as an exhaustion period. But you do see the island that formed in there. That's really what is significant. And then if you bought the opening over here, well, how was that? Perfect breakaway, perfect island reversal, and a perfect spot to say that something had changed in trend, and you get the breakaway, and it's just, well, gorgeous. So you can see that that the breakaway gaps are just crazy good. And if you get a sense for also using momentum indicators along with this, you will see how high of a quality these breakaway gaps are and how the momentum changes and how they continue. So again, you can use the slim ribbon or the Hall moving average, or you could use mobile breakout bands. Any of those are good momentum indicators that give you a good sense for the momentum continuing. Remember, the what I commonly use is the projection oscillator along with those type of patterns to confirm the continuing momentum when they get established. So you see me do that every single Friday when I look at the short-term momentum and compare the projection oscillator to the upward or downward momentum, and it gives great signals also. So it's a great way to confirm momentum. It's a great way to confirm that the new momentum that is established on breakaways or gap reversals, I'm going to show you right now, are really, it's really valuable information that the momentum is going to continue. Yeah, that's how you catch big trades. It's how you hold things for a long period of time. Remember, the secret to being a career successful trader that uses directional or information or technical analysis is that you can get more winning trades than losing trades, and that your winning trades are bigger than your losing trades. So many traders have a lot of problem with that because the tools they use shake them out of positions because the tools they use are pretty short term. But when you're looking at daily charts like this, you probably don't want to be looking at anything shorter than 1 hour or 2 hour charts along with them to make sure you don't get shaken out of position. So this is a good example of the value of seeing these trends get established and being able to catch the bigger trades. Not just make a point or two on a stock, but make 5 points or 10 points. And that can happen. In the case of this Exxon trade, the stock breaks away at $77 and now moves all the way up to $83. You can see that. So a very significant trade in there. And using a momentum indicator, you would see that, well, the momentum would have continued bullish through that whole period of time. So that's a look at Exxon and a look at breakaway gaps, right? Okay, we got so many of them here. The last ones we're going to look at, and there's just a few of these in here, are gap reverse. And also how we use, I use the word synchronicity a lot in when I look at groups. And that's because there's a commonality between peaks and valleys in groups. And usually you get information on one, you could look at the others to see, well, how that follows through. So I want you to take a look first at we're going to look at the brokers, which is at Charles Schwab. So that's SCHW is Charles Schwab. So what I want you to see here is what I believe to be an exhaustion gap on the upside. So here is Schwab. Now, it's been in a long uptrend right over here. Now, when you get a bar like this, kind of a doji with long legs to it, what it says to you is that, well, the upside pressure is meeting downside pressure. You had an upside gap in here, so it gaps up to this level, and then it gives up a little ground in here on high volume, and that warns that this level here of 46.21 is very likely to be the end of this upside move. So I would call this an exhaustion gap right there. It's a relatively small gap, and it's just been moving sideways in here, not much going on. But my sense was, looking at this, that this was topping. Now when I look at Ameritrade, you can see in here at the exact same period, there was a gap reverse. So what makes it a gap reverse? Well, generally gap reverses make new highs or new lows of a move. So you could see the upside gap here. And then it engulfs. In fact, it engulfed 7 days worth of trading right there. That, to me, is a clear example of a gap reverse. It's a hidden gap. Why is it hidden? Because you don't see the gap because of the bar. It gaps up over here and reverse. So typically, when you get a gap reverse, it's hiding a gap in there or a hidden gap, and that's significant. So that happens on massive volume and on the same day that we saw Schwab do that upside gap. And that is a signal for a top being formed in the brokerage group. Now, the brokerage group did well because it was being dragged up by the financials, and it's all about higher interest rates, which, we just had the Fed minutes, and they're coming out quite dovish. So, maybe that is also a signal for this and the financial group. Let's take a look at ETFC, and you can see in here that you have the identical pattern. So you can see high volume, upside gap, and reverse. So the gap in there is hidden. And a beautiful, what they call as an outside day or an engulfing pattern, any of that language, depending on how what different schools of technical analysis you're looking at. But this is another example of a reversal pattern. So just quickly, when you look at Schwab, you can see that right there, which is that long-legged doji on the high volume. When you look at Ameritrade, you could see the reversal there on that hidden gap or gap reverse. And when you look at ETFC, you can see the same thing, all on the same day. So what that says to me is that it's very likely that group has reversed. Now, when you talk about the financials and the banks, they're all going to be reporting in the next week or two. And take a look at Citigroup. Look at that. Highest volume we've had in weeks. It's only the middle of the day. The upside gap gets up here equaling the highs and reverses and engulfs 7 days right there. So, that might be a clue that the entire financial group is reversing, that it's, reached the level that it could, and that all of this thought that they were going to be able to increase earnings based on the steeper yield curve, a more hawkish Fed, may actually not be true, and they might have just run too far. So there you see the brokers and now Citigroup giving a clear sign that that upside move is over. Now, of course, you can extrapolate that into the whole stock market and say, well, if the financials are going to be running into trouble here, that could mean the stock market is peaking. I don't really want to make a big case about that right now. There's a lot more earnings to see in this group. I'm only showing you a couple. JP Morgan also the same thing, that it wasn't able to make good upside progress on decent earnings. So we may be getting to that period. And I just want to note, because of the importance to the entire market, that the financials are giving us messages, and that's worth noting. So there you go. We looked at common gaps, exhaustion gaps, breakaway gaps, and gap reverse that essentially is a hidden gap. And I think that you could see that generally it gives you information that something is starting, right? Something is clearly starting. Or in the case of gap reverse, something is also ending, right? Because we were in a trend, and that trend is ending and a new trend being established. So I like to think of it that when you get a gap, something is starting. And that's it's up to you to figure out what the meaning is to them based on the location on the particular gap. And is it coming out of a consolidation? Well, if it is, that's going to be a breakaway gap. Is it coming out after some long trend? Well, that's likely going to be an exhaustion gap or a gap reverse. And those are important beginnings of reversal trends. This is such great information for you to be able to establish biases in your positions and be able to hold them for a long while. Man, I can remember lots of times in my trading history where I put on positions because of this type of signal, and I just left them there for days and weeks, and they ended up paying off in a very big way. So that's kind of a mindset change also for a lot of traders that tend to want to be short-term traders and find it difficult to capture these bigger moves. It also is very valuable to investor types. And who may be in positions in any of these. And if you see continuation gaps, well, you're really happy because it's going your way, right? And it just enhances your belief in your position. You see reversals, well, maybe it's time to think about lightening up on a position, because pretty good chance you've got a big winner and maybe lock in some gains. Lots of value to all kinds of traders out there, and probably the least amount of value to short-term traders, unless you do focus on the momentum that's being established and make sure you bias your short-term trades in that direction.